Let's pick up on that conversation forward with Dipan Mehta. He joins in on the show right now. Dipan, hi, morning. Good to have you on the show as always. You think it's going to be a battle out there when it comes to private banks, or do you think the current leader, ICICI Bank, will win?
Good morning, and thank you for having me on your show. It's always been a pleasure. See, I think it's just that the private sector banks, I think even ICICI Bank will join that list of at performance or underperforming banks like HDFC and Kotak. And the reason for that is that there's a lot of excitement around the smaller banks, the PSU banks, where valuations are lower and growth rates are higher. I think we are getting into that phenomena where a lot of smaller banks will grow much faster. And investors are therefore shifting their allocation within the portfolio from the larger banks, the ones which have delivered exceptional returns, to the smaller ones, to the PSU bank, because that's where I think the risk return profile is better. They may not be the best banks, of course, looking at the past track record, but they are the best investment stocks at this point of time. And I think that's what's happening. And this will continue, I think, till we see some sort of a shakeout within the banking sector or the NPA cycle starts to pick up, which is when the smaller banks will feel the pain far more than the larger banks. So that's my assessment. But I'm not selling ICICI, HDFC Bank, or Kotak Bank. I'm just remaining invested. Most investors like me have been in it for many, many years, if not decades. And they're sitting on huge profits. And I think next 3-4 years also, there'll be secular growth compounders. So just a matter of time before they start to, deliver returns which are at least in line with Sensex and Nifty.
Right. Dipan, so let's extend that list. Curious to know if there are any other smaller banks that you've added to the portfolios or recommend doing so.
No, I think I've spoken many times about IDFC First Bank, and recently I think the CCI has cleared the merger of IDFC and IDFC First Bank. Not that it's a major event, but it's one process which will be over and done with, and it should result in improved capital adequacy for the bank as well. And apart from that, I think we are seeing very good numbers coming through from Federal Bank. I was very impressed with the numbers which came through. Another company which we and our clients are invested in. I think they're firing on almost all cylinders, and NPAs are very well under control. And I think one of the banks which is investing a lot in technology as well. So I think down the line also we'll find a lot of PSU banks. I thought Bank of Maharashtra came with good set of numbers, and same trend will be seen in some of the other PSU banks, especially the smaller ones like say Union Bank or UCO Bank, maybe even Bank of Baroda, Bank of India as well. So that's where I think that where we are focused on. And as I said, I think these are the banks which I think will outperform for some more time.
Okay. So, Dipan, I have a simple question. It's not that HDFC Bank and Kotak are not growing. They are growing. But their valuations have come down to levels which are pre-COVID, which are actually lower than pre-COVID and pre-LNFS. Is it just a phase of the market where the over ownership now has to get checked, and it's a matter of maybe a cycle, a bad patch, and they will regain their mojo? Or there is something fundamentally different in the way how one should approach financials now?
Well, I think it's just a phase. And while we are seeing a lot of money coming into mid-cap funds and mid-cap stocks directly by investors, we are going to see an oversized price movement in the small mid-cap banks per se, because that's where I think they're focused on. The minute we start seeing solid FII flows, that's when you will see HDFC, ICICI and the like start to do much, much better. But as I said, I think it's just that there's only so much that you can allocate to banks. And there are just so many banks which are now doing exceptionally well. So investor attention, investor allocation is shifting away from the top 3-4 banks to some of the other smaller banks. There was a time, I think if you go back to 2018, 19, and even 20, right through COVID, the larger banks like HDFC, ICICI, Axis Bank, they had their NPAs well under control. And mind you, Nikunj, the most important parameter, the data point to invest in the bank is the NPAs. And these top 4-5 banks had done exceptionally well on the NPA front, which is why they were the favorites of investors. But now I think you look around, a whole host of other smaller banks, including PSU banks, have net NPAs which are equivalent or slightly better than the likes of the top 4-5 banks. So that's providing investor comfort, and certainly they are cheaper price to earnings, price to book compared to these banks even as of now. and growth rates are in line or slightly better. So, and also liquidity is coming in over there. So that's what explains the interest in the smaller banks as compared to the top 4 or 5 private sector banks. But that can easily turn once you feel that there is a heightened competition within the banking sector and net interest margins are under squeeze, or the NPA cycle turns, because these larger banks have a far superior quality of balance sheet. They have a better deposit franchise, better brand, better technology platform. And that's when I think, when the times are tough in the banking industry, that is when I think investors will go back to the safety of these top 4 or 5 private sector banks.
Okay, lot of earnings, and today you've got Wipro as well as LTI Mindtree, and remember LTI Mindtree is a Nifty company as well. So let's take it across to Anisha and find out what to expect, and could we expect anything better than what TCS and Infy have done, Anisha?
Doesn't look like. I don't expect any big improvement coming in numbers of LTI, Mindtree as well as Wipro, because both these companies had reported a soft Q1. Over that, let's see how they perform, because at least for LTI, Mindtree, we're working with a growth of around 1.4 to 1.5% in terms of constant currency and dollar terms. Rupee revenue might accelerate a bit more, so 1.9% kind of growth is what we are penciling in. Growth would be led by their manufacturing vertical. We have seen good growth coming in high tech as well, but that might be moderated by the kind of performance that we have seen in the BFSI vertical, because for the last couple of quarters that has been a bit soft for LTI Mindtree. Margins might contract by almost 100 to 150 basis points on account of the wage hike impact, and that's the reason the profitability might also be down 3%. The other thing to watch out for is deal wins. There also we are expecting a bit of moderation in Q2 for LTI Mindtree versus the performance that we had seen in Q1. In terms of monitorables, the management had already guided that double-digit growth in FY24 is a tall ask. So if not that, maybe in FY25 is it possible or not, and whether they hold on to their margin guidance of exit rate of 17 to 18% for FY24 will be critical. Quickly moving on to Wipro as well. Last couple of quarters have been very dismal, both in terms of the revenue performance as well as the headcount trend that we have seen. As it is, the guidance that they had given for Q2 factored in a decline of 2% and all the way a growth of around 1%. For now, the street is expecting that the performance will be towards the lower end of the range. So we are expecting a cut of almost 1% when it comes to the constant currency as well as the IT service revenue is concerned. Margins might hold up okay at 16.2% because there has been some delay in the wage hikes which the company has pushed to Q3. Profitability will be close to around 2,800 crores. The big thing to watch out for Wipro will be the Q3 guidance. There also the street is very divided. The range goes right from a cut of 1.5% all the way to growth of around 2%. So let's see what the company actually delivers, because for now the performance has been rather weak, and hence of course the valuation discount that Wipro gets.
Okay. The valuation discount what Wipro gets, I mean, it's one of the stocks which frankly is on no one's radar right now. We can look at IT companies and say, okay, nothing is happening. But if I look at the deal pipeline, what has been communicated by a HCL Tech or a TCS or a Infosys, you know that orders are coming. So it is one of is large cap IT one sector where you say 6 months don't expect anything, but next 12 months you should expect something big.
Yeah, I think so. But don't expect major fireworks if they're growing at 4 to 7% or thereabout, or depending on which what company says, they start to grow at low double digit per se. And unless you don't see the US economy, global economy on full throttle and in a kind of a bullish phase in terms of overall economic trends as well as tech spending, I don't think these companies can go back to that 17-18% type of growth rates which typically investors look for when they are evaluating an investment. But the action is going to be more and more in mid-cap stocks, small-cap stocks, and that's where I think investors should focus on. Smaller companies, lower base, it's easier for them to continue to grow at that 15 to 25% type of top-line growth rates. And that's what I think, meets the benchmark of many investors, because that's where the compounding comes into play. Also, I think that after almost, I would say I've been tracking this industry for 2.5 decades, I feel that mid-cap companies are able to create a niche for themselves. They've been able to compete with the large cap IT companies. They are bringing a lot more value to the customer. Customers have recognized their certain skill sets and certain domain knowledge, which is why I think they're getting a good flow of orders as well. So I would, even if things do start to improve in the US market and globally, I would still like to continue to place my bets with the mid-cap IT stocks, especially the ones which are focused on niche segments where they have created a very solid, I would say, expertise, which is valued by the customer and now I think by the street as well.
Okay, let's also find out what are some of the technical charts of the buzzers in yesterday's trading session indicating. And Naresh, wanted to get in a take from you on the charts. SIAT, if you've had a look at it, as well as something like an Ircon International, that's been awfully volatile and wrapped up yesterday at 160.
So SIAT saw result reaction, opened up with a big gap, did not sustain all through the day. It drifted lower. So that's an indication that the market is not ready to accept the results in a positive sense, even though the numbers were better than expected. So for now, that indicates we are going sideways. Unless and until we cross the highs of yesterday, the stock could get into a new range, which is basically 2000 to 2350. So technically, not looking interesting as such. So would expect a sideways drift to continue. Ircon, that's a stock which has seen a lot of volumes yesterday as well as a day before. The trend has been positive right from the time it broke out in the 60s. The previous high for the stock is 170.75, which would be tough to cross. So I would expect some bit of, say, consolidation here again, but with a higher range. So time to take some profits off on Ircon, not a buy at current levels.
Okay. What's the view then, Dipan, on Zomato? If I recollect, it was one of the stocks within New Age Tech that you were bullish on. Just today, we've got a positive brokerage note. They're talking about World Cup trends, ad spends picking up, and all of that is going to work in favor of a Zomato. Your views?
No, I think nothing has changed. We remain very positive on Zomato. And I gather that even the quick commerce division, the Blinkit, which they acquired, that also is showing very good growth rates and expanding in a sensible manner. And my sense is that you could expect some positive news from that particular division, which has been a drag in the upcoming results as well. I think the food delivery business is kind of, just growing steadily. And at some point of time, maybe 8-10 quarters down the line, it will be a solid contribution to the profitability of the company. And I think that as an investment, as a company, it's shaping up really well. And a lot of the doubts that investors had about when it would break even and when it would start reporting positive earnings per share, those are being gradually addressed. And I think that valuations also are pretty decent if you extend it into, say, 3-4 years down the line, and then expect the company will grow at 15-20% or thereabout. I think you have a winner on your hands. Again, a disclosure, we and our clients are invested, so please do your due diligence before buying into the company. It's not a recommendation.
What is your target price for Zomato? I mean, you have to be mindful of that as well, because now it's a market cap of about $10-12 billion, almost 80-90 lakh crore. So how do you say that this is the right price and this is what could be the potential of Zomato? Because it's no longer like a tiny toon. It's no longer a $5 billion company. It's almost like a 90,000 crore market cap now.
Kunj, I've been asked this question many times on many stocks, and I always said that I don't have price targets, I have growth targets. And I will remain invested in Zomato so long as they're able to grow at above 30% top line, period. I think that's my benchmark. If they can continue to grow at 30% top line for 3 years, 4 years, 5 years, 10 years, then it will be a multi-bagger. I'm pretty certain about that. So I don't want to keep any price targets, because when you keep a price target, you may sell at that price target and the company continues to grow and deliver exceptional returns after that. So in my opinion, price targets are meaningless. If the company does everything sensibly, has a decent capital allocation policy, and there's inorganic growth like Zomato of 35% or thereabout, remain invested. I think at some point of time you'll be handsomely rewarded.
So can you give me an example, Dipan, where you've said that, look, I bought the stock, it was expensive when I bought it, I ignored what brokerage is and what the conventional wisdom was, and my conviction was rewarded. I just want to bring this point out for our viewers, because, I mean, it's easy to buy a stock, but it's difficult to really not sell the stock. The temptation to sell a stock when it goes up 10%, 15%, I think is very high, and I respect that. But big money, viewers, is always made when you buy a good company and you just sweat it out. and then you hold it. So can you give us an example, Dipan, like what has really worked for you in your real life?
So I'll tell you what has not worked and what we missed. One is Trent. I think it's a phenomenal story, and it's been a multi-bagger. And any point of time when you entered the market, it was expensive. It was never ever a cheap stock. I mean, it was always 35, 40 times, and still it has done exceptionally well for the last 10 years or so. One company which did work out for me was Tata Elixir. It was always the most expensive IT stock, even 5 years, 10 years, 15 years ago, if you go back. And yet it's been like a 40, 50 multi-bagger. So these two companies come to mind. Third is PI Industries. In 10 years ago, also, it was trading at premium valuations compared to UFOS and some of the other agrochemical companies. And that's also been a fantastic multi-bagger. So I think valuations, I don't even remember what P multiple I bought these companies at, 4 or 5 years ago, or even, 10 years ago. So I don't remember also. But I knew that they were good quality companies. And I don't think I paid, a cheap P multiple for them. And yet they continue to grow. And, when companies are in growth phase, investors tend to pay a much higher P multiple. So you'll be surprised that a stock you bought at 25, 30 times P multiple, 5 years, 7 years down the line, that the growth rates are sustainable, the business model becomes even better, and there are higher barriers to entry. Suddenly the P multiple goes from 25, 30 to even 60, 70 or so. So I think these things I've seen in the past, and the important thing is to buy good quality business and hope and pray that they can keep on growing at that 20, 25% type of growth rates for extended period of time. And that's when you have a solid multi-bag on your hands.
To real estate, did you miss the bus? What is it that you hold within this space? Because in the last month or so, there's been a pretty fiery rally that's taken place.
No, I think we were very early into Godrej Properties, and in a way, Godrej Properties has underperformed some of the other larger or even mid-size real estate companies. But this is like a 4-5 year cycle, very positive on it. What I appreciate the best is that all the large listed companies are, acting in a very responsible manner, focusing on sales, focusing on quality of balance sheet, not overextending themselves. The last time investors got very badly hurt in the real estate cycle because these companies just went after land bank, and that kind of messed up the balance sheet. But this time round, it is all about new projects, immediately trying to sell the new projects. The regulatory framework is far better from the organized real estate players' point of view and from the customer point of view. And even if you felt that presently these companies are pretty well, I would say, valued in line with their net asset value. Every now and then they are getting new projects. I think you keep an eye on the newspaper, whether it's a Shobha or a Macrotech or a DLF, they are doing some new project, redevelopment project, or acquiring some land bank, or doing a JV with a smaller player. So they are also continuously increasing their net asset value and their land bank and the kind of potential square feet that they can deliver over the next 3 to 5 years or so. So these are great times for these companies, and all of the balance sheets are fantastic. In terms of corporate governance also, which was one of the biggest fears in real estate, I think that also is gradually coming down because of RERA and all the places, and increased scrutiny by the regulator and by the market and by the government. So I think these are absolute blue sky scenarios for real estate companies.